Welcome back to 𝐘𝐿 News. I'm Jeremy Safran. Well, gold has been the star performer of 2024, rallying over 30% and hitting record highs above $2,700 per ounce. But with such a monumental run, the big question is what's next? And is the rally set to continue into 2025, or should we brace for another correction? Last time we had our very own Gary Wagner of thegoldforecast.com joining us. He accurately predicted a correction that played out as he said it would. And he's back today to give us an updated technical outlook, including key support targets, what the upcoming Fed meeting means for gold. Gary, great to see you as always.
Thanks so much. It's always great to be here.
I mean, it's been such a heck of a year so far. I can't even believe that we're going into the end of it. But as I mentioned, Gary, last time we had you on, you mentioned that we are due for a correction in gold's bull run. I mean, it seems like that correction really played out with gold finding support around key levels before heading back up. So, I mean, what's your analysis on where we stand now?
Well, if they could put up the chart, it's a basic daily candlestick chart of gold. And as this market went up, it touched as high as $2,800. We're looking at February gold in terms of pricing so that our listeners and viewers have a good sense of what it is. And we finished a full cycle of an Elliott wave count, which is waves 1 through 5, called the motive phase, which means we go into the corrective phase. Corrective phase is typically an ABC correction. So we went from above 2,800 down to this low at 2566. That's labeled the A wave. And then typically on a B wave, the basic model is it will fall anywhere between 50 and 75% of the drop in the A wave. And you can see that as it came back up, it came up to 2742. The high that is predicted at 75% is 2762. So not really in the middle, but just above the middle. Now we're in our final C wave, and this is what's thrown many traders off. On a C wave, you're typically going to get a hard fall like you did here. However, you had that strong sell-off day from 2742 down to 2651. One of the largest daily price declines, if not the largest, this year. And we expected it to continue to trade lower. I'll talk about where I think it could go. But out of the last 4 trading days, 3 of them were up. So it seems counterintuitive to the models that we use, at least. I think that we could possibly get what's called a truncated C, meaning it doesn't go to the low achieved, which is 2566, or lower, which would take it as what's called a standard zigzag. But we have to realize as a technician that fundamentals are going to drive the market. The technicals are really good for areas of support and resistance where we look for tops or bottoms, but they don't guide the direction. Traders guide the direction, the flow of money into the markets, whether they're buying or selling or sitting on the sidelines. That's the key. And so I think we could get a little pop here. It could be over today. We could get a little pop here. If it breaks above, let's say, 2690, then I think the correction's over. And the way this theory works is it's an 8 count. Waves 1 through 5, the motive phase, your ABC correction, the corrective phase. All things being equal, the clock restarts. And I am adamant about believing that we'll continue to do what's called a bull count. A bull count obviously happens when the market is moving higher. And so I expect that next year is going to be a really, really strong year for gold. But in terms of the call right now, as we look at it through the eyes of a daily chart, and I'm going to do one thing for our viewers. I'm going to convert this to what's called a Henkinashi. And a Henkinashi is Japanese average chart. And you notice it looks a lot like a candlestick chart with one key difference. the open is not the true open, but rather fixed from the midpoint of the prior candle. On daily candles, it's the midpoint of the prior trading session. But what's nice about it, as you can see on the last leg of the rally to 2800, you get all of these green candles. Then you get your pivot candle, this very small body red candle, and then it comes down, and it's that color change that we look for on the bottom, from red to green, on the top from green to red. And it gives you a really strong indication of strength of trend, which is determined by body size. The one thing that no chart can really help one with is when we have a range-bound market. And it's easy to identify. You have a series of candles with alternating colors. There's no clear defined trend. But the beauty of this type of chart is the fact that it is exceptional for delineating trend strength and trend momentum, as well as points of key reversals. I'll move it back and I'll listen for your next question.
Yeah, well, I'm curious. Okay, pull that out a little bit. I mean, you talked a little bit about those key support levels at 2560 or 2690 rather. Gary, talk to me about December. I mean, we have a lot of things coming up, including that FOMC meeting, and I know that's the macro front, but on the technical side, I mean, what are the key support resistance targets that you just mentioned? One more time.
Well, I mean, resistance is obviously major, is above 2800.
Yeah.
Minor begins, and again, this isn't spot, this futures 2743 is based on this top here, the conclusion of B, as well as you can see it matches up here, and roughly matches up with this area. Mm-hmm. In terms of support, you have to look at support as the most recent low, and that's at 2566. There's minor support around these lows at about 2640.
You know, there's some indicators suggesting that, you know, there's some overbought conditions, while other analysts continue to point for this momentum. So, I mean, where do you see, and what's the signals here for the short-term volatility, you know, pushing into this year? What are your expectations?
Well, let's take a look at what those guys are looking at. Let's just adjust this. I'm putting up a stochastic oscillator. I just need to smooth it. And what you do, this is a stochastic oscillator, and to determine overbought, you want to see these two lines, the %D, %K, move above 80. And then what you look for is the cross, and that's when you would typically get your sell signal. You can see that here. You can also see when it moves sideways, it gives you that same noise. So with that in mind, we had a beautiful scenario back on November 14th where it dipped below 20, actually went as low as 2 and crossed. And that was when we got the signal for this buy signal here. So I've used stochastics for 45 years now. Right now, we are neither overbought nor oversold. Overbought is above 80. Oversold is below 20. And we're sitting at roughly at 50. Wow. So we're right in the middle. I can show you other indicators, but for the most part, Jeremy, really what I think technical traders, fundamental traders also are looking at is momentum. Because in the charts we'll look at in a minute, when we look at the year, I'll kind of give you a peek of what I'm looking at for next year, but mostly for December. Mm-hmm. The momentum has been strong. And incredibly, when you look at a monthly chart, it's just literally a vertical line that starts basically in February. But the rally started, I believe, in October of last year.
Yeah. Been wild to watch, though, huh, Gary? I mean, you and I have touched base on this. I mean, obviously, we have the central bank buying, we have potential sticky inflation, you know, with these rate cuts. So do you agree with the bullish outlook? I mean, give me your expectations. What are your thoughts for going into next year? What's 2025 look like?
Well, let's first take a look at 2024, because as a market technician, for me to determine a valid forecast, I need to know where it's been and how it got there. and determine what parameters were in the market to take it to the levels it did, right, and then determine if those items are still in the market. If we look at the start of January in 2024 up to this high, realize we've still got a month, gold gained 29%, $646. But as I said, I believe that the actual rally began in October. And so you had here 12.27%, 244 plus 646. So you've got $900 in this area. And so far we have given back roughly 6.65% at current pricing. Of course, if we take it to where this low was, but it's not there now, we were down 9% from there. So we had strong momentum. Now, what was that based on? It was based on central banks accumulating. It was based on inflation. It was based on geopolitical conflicts. And let's take a look at each one of those, and then Fed. And there's other variables. The geopolitical conflicts are still fully in play, although there was a ceasefire on the Lebanon side in Israel, which is a great thing. You don't want that war to widen. There's, in my opinion, that conflict is far from being resolved. Then you've got Ukraine and Russia, and that, in fact, has been ramping up. Biden allows changes the restrictions on targets that can be hit inside Russia. Russia has been devastated. I think they're losing about 15,000 troops per month. They're bringing in North Korean soldiers to aid in the fighting. I think it's just cannon fodder. They're just putting them in the front. But the thing is, we don't see a de-escalation there. So if those are one of the primary factors that move gold higher and they're still in play, I would expect that to create bullish undertones. The next thing is inflation. Inflation has been coming down. And as it comes down, there's a standard correlation. Higher inflation leads to higher gold and the reverse. But what's going on now is central bank interest rate normalization, because gold doesn't yield as an asset, it doesn't yield any percentage of return. As interest rates move down, it makes bonds, securities, and things like that less attractive because the yields are going down. So I expect the Fed to do a 0.25% rate cut this year or in December. That would be a total of 1%. Their goal is to take current Fed funds rates to 3.5%. And I believe they'll get there by, could be the second quarter of next year down to the third quarter. Lower interest rates are going to be a bullish undertone for gold. And so the bottom line is, the last thing is Trump. We know what happened last time he was a president, and we know what he's on record saying. He seems to be pretty true to his word, maybe not to the statements he makes sometimes, but if he says he's going to do something, typically we've seen him actually do that. And he's committed to tariffs, not only in Canada and Mexico, which is a new one, but to increase the tariffs in China. Now, what does that mean? If tariffs are 25% and I'm buying a toothbrush from China that's $1, I now pay $1.25. If that isn't the definition of inflation, I don't know what is. Tariffs will create tremendous amount of inflation. He also created more debt for the country. He's not alone in that by any means. That kind of seems to be the standard practice of almost every president that, since I've been around and alive and followed, debt has been accumulating. And so what that does is plays against the currencies, and the dollar in particular is sensitive to what we do, but the euro is sensitive to the European countries in the Eurozone. So when we see the fluctuation in the dollar and we look at a dollar chart,
been resilient.
we're looking at
Yeah.
I'm sorry?
Oh, it's been resilient, the dollar too, Gary.
It has been, but here's the thing. The resilience that you're looking at is in the relationship to other currencies. The dollar this year bought much less than last year, and last year bought much less than the year before. In other words, the value of the dollar, when we look at these charts, we're just comparing them to other currencies. We're not comparing them to the buying power of the dollar.
Yeah.
And so it becomes a little misleading when we go, the dollar is strong. Well, yeah, it's strong against the euro, and that's important if I'm going to travel overseas and I've got to buy stuff in euros or whatever country I go to. But when we look at North America and you look at Canadians using Canadian dollars and you look at Americans using US dollars and the peso in Mexico, what's important, they don't care what the dollar is in terms of strength in relationship to another currency. That's meaningless. They care about how much it costs for a dozen eggs, a pound of flour, a pound of meat. And the problem that it continues to really be tantamount, and it's the most worrisome item on the agenda for me, is that we talk about dollar strength, but what we should be talking about is dollar strength in terms of buying power. And I think the reason they don't is it's a very scary subject when you realize that a $20 bill now maybe could get you a couple, 4 people a cup of coffee at Starbucks, whereas $20 100 years ago, you could buy a suit.
Absolutely.
Big difference.
Yeah.
And so what I'm saying is I'm looking at how this market moved, so that we had really gains of about 600. We've got to take back at current pricing about 200, and we haven't finished the month. I would say, regardless of where we do conclude this C wave, even if it's down here, absolutely without any question, we will restart the clock. In other words, we will restart the clock by going wave 1, wave 2, wave 3, wave 4, wave 5. Each of those waves, 1, 3, and 5, go to higher pricing. Then you'll get your correction. All things being equal, we've got 1, 2, 3, 4, 5, and this is the highest price gold's ever been. We'll weather this correction. Once that concludes, the bull count restarts, and that's going to pick up $400 or $500. And how many of them do you get in a year? Typically, you get 2 full counts. And so I'm very bullish. I'm not going to give you my exact numbers yet. We'll save that for the outlook, but I'm exceedingly bullish for gold next year.